Canadian house prices in 2025, boom or bust. Four major financial institutions have released their forecasts with striking differences. Royal LePage predicts 6% increase, while TD Economics foresees a 3.2% drop, with RBC and CRE landing in between. Same market, vastly different conclusions. I've attached my citations in the description below. These experts disagree for specific reasons. It comes down to three critical factors: interest rate projections, regional supply imbalances, and the potential US trade policy impact. We'll examine how each factor influences the forecasts differently, revealing which prediction might matter most for a specific location and property type. The numbers tell a confusing story when it comes to Canadian house prices in 2025. Reports from four major financial institutions and their forecasts couldn't be more different. It's like they're looking at entirely separate markets rather than just the same country. How can experts examining identical economic indicators arrive at such widely different conclusions? When we examine these forecasts side by side, they read like weather reports from different seasons. Royal LePage predicts 6% growth in average home prices. CRE suggests a 4.7% increase. RBC projects minimum growth of 1.4%, while TD Economics forecasts a 3.2% decline nationally. For buyers and sellers trying to time their market entry or exit, these conflicting signals create a genuine dilemma. So why these discrepancies? It's all in how each institution weighs key factors: interest rates trajectories, population growth patterns, and potential trade disruptions with the United States. Royal LePage's optimistic outlook builds on momentum observed in late 2024, particularly in markets with increasing transaction volumes after stagnation. Their analysts interpret this as a fundamental shift in buyer psychology, with mortgage rates trending downward, releasing significant pent-up demand. TD Economics focuses intensely on weakness in Canada's largest housing markets, emphasizing structural problems in Ontario and British Columbia they believe will persist regardless of modest interest rate cuts. The oversupplied condo segment in Toronto especially concerns the researchers, with thousands of newly completed units hitting the market simultaneously from pandemic-era construction. RBC acknowledges the positive impact of lower borrowing costs, but emphasizes persistent affordability challenges. Their economists note that despite anticipated rate cuts, mortgage qualification standards remain significantly tighter than pre-pandemic levels, preventing many potential buyers from qualifying for adequate loans. CRE forecasts draws on their nationwide sales data showing normalizing inventory levels and renewed buyer interest. Their appreciation projection comes from tracking actual transactions rather than just economic modeling, observing how reduced borrowing costs translate into increased purchasing power. What's particularly revealing is that despite these national disagreements, there's remarkable consensus about regional performance. The Prairie provinces, Alberta, Saskatchewan, and Manitoba emerge as clear winners across all forecasts. The consistency highlights perhaps the most significant insight. Canada's housing market has effectively split into two distinct markets with fundamentally different prospects. While some provinces face significant headwinds from affordability challenges and oversupply, others benefit from stronger economic fundamentals, better affordability metrics, and tighter inventory conditions. The Prairie provinces enjoy multiple advantages: lower average home prices that remain accessible to middle-income earners, stronger population growth from interprovincial migration, and relatively tight housing supply. These markets still offer viable entry points for first-time home buyers and solid investment potential even if interest rates remain somewhat elevated. The stark reality of Ontario and British Columbia's housing markets tell a cautionary tale compared to the Prairie's success stories. TD Economics paints a concerning picture for these traditionally hot markets in 2025, with Ontario projected to experience a 6.4% decline in average home prices, and British Columbia facing a 4.1% drop. These represent significant corrections in market while many homeowners have built their financial futures. What's driving these downturns? According to TD's senior economist Rishi Sandhi, muted demand conditions have created a fundamental imbalance between supply and demand. After years calling the shots, the pendulum is swinging decisively toward buyer in both provinces. This shift transformed the market dynamics that have defined these regions for decades. Looking closer at urban centers, the Greater Toronto Area condo market stands out as particularly vulnerable. This segment is leading Ontario's broader price decline. Analysts point to dangerously high inventory levels, like a reservoir approaching overflow levels, combined with weakening rental demand as primary markets. The math simply doesn't work for thousands of investors who purchased pre-construction units at peak prices and now face the harsh reality of negative cash flow as interest rates remain elevated. For these condo investors, the financial strain is intensifying. Many bought multiple units based on projections assuming continual price appreciation and strong rental demand. Now they're caught in a perfect storm. Higher carrying costs from increased interest rates, softening rental markets unable to cover those costs, and the prospect of selling into a declining market. Turning to Vancouver, its situation mirrors Toronto's challenges, despite its beautiful setting and limited geographic footprint. Vancouver can't escape the fundamental affordability issues plaguing its market. Even with anticipated interest rate cuts, the city's stratospheric prices remain out of reach for many potential buyers as we move into 2025. The CHMC housing market outlook presents a more nuanced view for Vancouver, projecting that decline prices that began in 2022 will end in 2024, with average resale price growing in 2025. By 2026, their analysis suggests the lower mainland's average resale price will actually surpass the all-time high last seen in early 2022. For Toronto specifically, CHMC forecasts a decline in housing starts through 2025, primarily in the apartment segment. Developers have adopted the pessimistic stance due to challenges in both demand and supply sides. First-time buyers in these provinces face a perplexing dilemma. Should they buy now at somewhat lower prices but shoulder higher interest rates? Or wait for potentially deeper price drops while risking rate increases if inflation resurges? This uncertainty creates analysis paralysis for many would-be homeowners. CHMC predicts Toronto average MLS price will rebound in 2025 with continued growth forecast through 2026. This recovery will be supported by decreasing mortgage rates, robust population growth, and an improving economy. If Toronto's housing market is merely recovering while Alberta's is stronger, with inventory levels near 20-year lows and thousands of Canadians relocating to the province in search for affordable housing, the prairies have become Canada's unexpected real estate success story. This regional powerhouse is showing that in real estate, location truly determines destiny. While examining the housing outlook across Canada, Alberta, Saskatchewan, and Manitoba are creating an entirely different market reality from the rest of the country. The Canadian Real Estate Association anticipates increased demand will manifest primarily through price growth in these provinces, creating a stark contrast to the struggles seen in British Columbia and Ontario. This fundamental divide stems from basic economics. When demand collides with critically low supply, price will rise. Calgary and Edmonton are experiencing unprecedented inventory shortages, with housing stock at levels not seen in 2 decades. Unlike Toronto's oversupply issues, the challenge in Alberta is finding homes enough for all of the people who want to live there. The province continues to benefit from the fastest population growth in the country. This interprovincial migration has created a self-reinforcing cycle. As more people arrive seeking housing affordability, they drive up demand, which then pushes prices together while maintaining Alberta's relative affordability advantage compared to Toronto or Vancouver. Every prairie city tells a similar story of transformation. Saskatchewan offers some of the most affordable major housing markets in Canada, creating fertile ground for both first-time buyers and real estate investors. Saskatoon's labor market has seen exceptional growth with full-time employment, providing economic foundation necessary to support rising home values. The CHMC specifically highlights Saskatchewan's potential, projecting price growth that will exceed the national average. Prairie rental markets reflects this growth trajectory, with low vacancy rates and rising rents, particularly in Edmonton and Saskatoon, where strong employment gains and migration are supporting rental demand. For potential homebuyers and investors, the anticipated interest rate cuts in 2025 will likely have their most powerful impact in these affordability-focused markets. Unlike Toronto and Vancouver, where even substantial rate cuts may not overcome fundamental affordability barriers, prairie provinces offer markets where rate-sensitive buyers remain active. Calgary's resale market demonstrates this well. Already seeing price gains supported by low inventories, the city's average prices are trending upward. The increasing demand for more affordable units like row homes and condominiums suggests that even as prices rise, buyers are adapting rather than abandoning these markets altogether. Looking at all the citations I've pulled together, it's clear there isn't a single Canadian housing market, but rather a collection of distinct regional markets, each with their own trajectory. The takeaway is about understanding your local conditions. Major life decisions require local knowledge, not national headlines that may contradict your city's reality. Your investment strategy should align with regional market realities. While the prairies thrive, Ontario and BC wrestle with affordability downwinds. The critical question remains, is it time to get into the market or wait further? If you are getting into the market, be sure to watch my next video on how I would buy a house in Canada in 2025. Thanks for watching.